I just bought Fortinet stock. In this video, I will show you why. If you don't know Fortinet, don't worry, I will explain the reasoning, the market reaction. I bought because the stock crashed after the recent earnings report. So in this video, I will explain why I'm buying, the reason of the drop, why I think it's a pretty good price. We will play with some numbers. I will show you some charts. If you don't know what Fortinet is, I will show you the financials of the business model. I will show you the qualitative aspect of the business model. We'll talk about the growth rates. We'll talk about the valuation. We'll talk about the latest earnings move. We'll talk about everything in this video. What Wall Street is estimating and how I see the situation. We'll even do a DCF. Let me just add a quick tab so I don't forget. We do a DCF with my assumptions and what I plan to do with my Fortinet. If I plan to sell it with quick gains, or if I plan to buy more in the near future. So that's it. You will have a clear plan for this video. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And this is not the first time I'm buying Fortinet. Actually, I did buy Fortinet back in the days, in 2020. I bought when the stock was doing nothing for a couple of months. And I sold, it was like a quick double, a quick triple. Let me show you the chart. I don't know how long this video will be, but I want the video to be quite complete, so you have a clear picture of everything that is happening. So you can leave this video with a lot of value. Okay, in 2020, I bought Fortinet. All the cybersecurity companies were going up and to the right. And Fortinet, which is a cybersecurity company, didn't go up and to the right. But the fundamentals improved drastically. In 2020, during lockdown, the world became more digital. So the cybersecurity industry was about to boom, to benefit from the situation. And apparently Fortinet was not moving. People didn't think that Fortinet would benefit. So guess what? I invested heavily back then. It was a pretty big position, I would say. And just after this, as a rebound, people started to see the situation with Fortinet. The stock went up because fundamentals improved as expected, because the world became more digital and you had more demand for all the cybersecurity industry. So I bought in late 2020 at a adjusted price, adjusted because there was a split of, let's say, I don't know, $20, $25. And I held, and I sold here at $60. So it was a quick triple in 1 or 2 years. And since then, I continued to monitor the situation, monitor the company. It's been on my radar for 5 years now, and I just continue to follow, monitor. The stock has been doing nothing for a while, and then going up, going down, going up. In 2023, the stock crashed a little bit because of a slowdown in revenue sales. And then everything rebounded because it is a business that is continuing to grow, and people are freaking out, and then people panic and sell, and then the business rebounds and people panic buy again. And now we have a revenue slowdown another time. So I took this opportunity to start a position here. The scenario we see right now in 2025 with a slowdown in revenue growth is very similar to what happened in the past. To that extent, I think this is a temporary issue. Let me talk about what they do. Let me show you the financials, and let me show you the earnings report. Okay, so I'm on Guru Focus right now. Fortinet has a market cap of $60 billion. And let me read the description. Fortinet is a platform-based cybersecurity vendor with product offerings covering network security, cloud security, zero trust access, and security operations. The firm derives a majority of its revenue through sales of its subscriptions and support-based business. The California-based firm has more than 800,000 customers across the world. Fair enough. This company was founded by two brothers, and they are still here. The Xie family. You have Ken Xie that owns 8% of the shares, and his brother Michael Xie, that is the co-founder, president, chief technical operations, CTO, and director, owning 7%. So 8, 7, that's a mix of 15% insider ownership. And it's a founder-led companies. Not a lot of cybersecurity companies are founder-led. So they have built this company 20 years ago, and now they are still the CEO, still the bosses, basically. Still monitoring everything, controlling everything. On average, if you invest in companies that are founder-led and the founder is still here, normally you have a better performance. On average, founder-led companies outperform other companies. Okay, so the Xie family is a conservative family. That means they will not take a lot of debt to fuel operations. Actually, they don't like the debt. If you look at the balance sheet, let me start the analysis with this one. They have almost zero debt. For many, many, many years, they have run operations without any debt. Look at this. The cash here is in green. The debt is in red. They took a little bit of debt in 2021 because debt was free back then. And they will repay it soon. That's it. That's the only leverage background you have around the company. All the rest is filled with cash. So as I told you, you have a market cap of $60 billion and a cash balance of $4 or $5 billion. So almost zero, you have zero problem with that level. Okay, fair enough. The balance sheet, perfect. That's a 10 out of 10. What about the revenue for this one? Revenue, look at this, up and to the right. If I check, I'm on Stock Unlock right now. If I check Fortinet and the revenue for the past 20 years, this is a company that has grown revenue at 23% per year for 20 years. You don't have a lot of businesses that can grow at 23% per year. In a growing industry, that's a growing tailwind. Being in a cyberspace is very bullish. And for the past 10 years, you have a growth rate of 22%. So it was not only the first 10 years that were having a nice pace. The remaining years, the most recent years, are still very good. And if I look since 2020, since COVID, again, a growth rate of 20%. Okay, fair enough. Okay, so revenue going up 23% per year. Net income, you have the same thing. Don't mind the change in 2017. It's just an accounting change because they sell subscription-based services. And because of a change in accounting, they have to account all the revenue upfront, all the net income upfront. So this is an impact on margin. So since 2020, even before, I can tell you, because of this accounting change, actually, the CAGR would be false. So please don't fall into this trap. A good way to account for the profitability of Fortinet, that's the free cash flow per share. That's the free cash flow. And if you look at the free cash flow for this business, look at this, up and to the right. This is exactly what we want. The cash from operating activities for this business, it has grown by 26% per year for 20 years. And if you look at the free cash flow for this business, 25% per year. So now we are definitely in the quality compounder kind of stock, right? For the past 10 years, you have a CAGR, a compound annual growth rate of free cash flow of 25% per year. Okay, I hope my pitch was convincing enough. This is a business that grows a lot, and this is a business that has dropped significantly since the latest earnings. So, but I want to put this in perspective. Since COVID, everything has gone up by 20% per year. The business is still growing massively. Okay? By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. What's next? The return on invested capital, ROIC, is healthy at 20-25% per year. The company doesn't have a lot of capex. Like many cybersecurity companies, capex is very low. If I look at the this and this, Okay, revenue. Fair enough. So in this chart on stock unlock, at the top of the screen, you have the free cash flow in dark blue. And in light blue, you have the capex. See the size? See how I mean, I can even show you this, it would be even bigger. See the size? You have a big difference between cash from operations and capex. So minimal capex for this business, like all the cybersecurity companies, by the way. So minimal capex, growing healthily in a growing industry. Fair enough. In the future, you can guess that they will need minimal capex. They are building their own data centers. They are starting to build out more infrastructure, but still, even if they are going more capex intensive, we are talking about 10% of the operating cash flows. So no big deal, actually. And what about buybacks, dilutions? If you look at the history of the company, they are a net buyers of shares. They do more buybacks than dilutions. And if you look at this chart, you see that they didn't do buybacks every year. Actually, they seized opportunities when the stock was trading cheap. They did some buybacks. So capital allocation is very smart. First, when it comes to capex, I mean, without growing your capex sustainably, you can continue to grow operations 20% per year. Fair enough. ROIC of 25%. Fair enough, you are efficient. And at the same time, you use your excess cash to do buybacks. Things are green flags in this category because that's founder-led. They know what to do. And I want to mention buybacks, but I also want to mention dilutions and SBC. First, let me tell you something about the buybacks. In the latest, I can show you what I mean. Okay, buybacks, cash flow. That would be it. Investing activity, no. Financing activities. That should be this one on FinChat. And at the same time, I want to show you, would it be the stock chart? EV to free cash flow would be fine. On a quarterly basis. Let me add some color on this one. During COVID, the stock was cheap. Management seized the opportunity to do some heavy buybacks. Okay, see this red chart, red line here. If it's down, it means buybacks, right? When it's up, it's because they issued debt at this level. Okay. In 2017, the stock was trading cheaply, buybacks. In 2020, the stock dropped cheaply, buybacks. In 2021, the stock was expensive here, so they stopped the buyback a little bit. So small red lines here, and they issued more debt. And then the stock started to drop, buybacks. When the stock was trading at the EV to free cash flow of 17, like below 20, they continued the buyback program. Then the stock was trading expensively, they stopped, and then the stock dropped, and they continued to increase the buyback program. Now, the management did a $400 million buyback program. They bought some shares during the April correction in 2025. They say it on the earnings call, the amount of shares that is being bought at a given price, so you can guesstimate the share price at the time of the buyback. If I'm not clear, don't worry, give me 30 seconds. So you go to investor relations, transcript, you do Control F, share. So we repurchase 4. This is the latest earnings call, the commentary from management team. They said we repurchase approximately 4.6 million shares of our common stock for an aggregate cost of $400 million. It's very easy. How do you know the average price of the buyback? You do 401 divided by 4.6. That gets you $87. When was Fortinet trading at $87, and it was here. So during Q1 2025, is it Q1 or Q2? I'm mistaken. Or Q2. So yeah, maybe they have a. Okay, anyway. So between the end of April here and here, during this period, they did some buybacks at $87 here. So they took the opportunity. Again, you have a market drawdown, the stock is getting repurchased by a lot. And now they reported earnings now, and the stock dropped 20%. My strong guess is if they thought the stock was cheap here in April, they will think that the stock is very cheap right now. So my strong guess is they will increase the buyback program by a lot for Q3 2025. And actually, they have dry powder. As I told you, they have a cash balance of $4 or $5 billion. You see the decrease here in cash, it's because of the buyback program. My strong guess is they can put up $500 million or even $1 billion. When they are doing heavy buybacks like in COVID, they did $900 million in one quarter. In December 2023, they did $900 million in one quarter. They can do the same. I wouldn't be surprised if they do $1 billion of buyback. They have a buyback program with remaining $1.6 billion. I think so. The remaining share buyback authorization is $1.6 billion. Exactly. So I wouldn't be surprised during the next 3 months, you have, or even 3 months or 6 months, you have a press release that is being released to the public saying Fortinet is increasing the share buyback program. It will be the equivalent of saying we used everything. We used the $1.6 billion. I guess it will be used during 2025. That would be my guess. Okay, so I've talked about buybacks, I've talked about the growth rates, I've talked about what they do, I've talked about insider ownership. Let me show you how I like the insider ownership. Because the SBC, the stock-based compensation of the business, is very small. Let me show you what I mean. CapEx, cash flow from operating activities. This is your SBC. Or I can SBC and cash from operations. Very well. If I go on an annual basis on Google Focus, and I focus on operating cash flows and SBC, I don't know if you can see clearly, it's in pink, okay? And operating cash flows are in yellow here. SBC, so stock options, free stocks that are being given to employees to reward employees, that's a very small part of the operating cash flow. That's very rare in the cybersecurity industry. Actually, I can show you what I mean by doing this. If I compare the SBC of Fortinet to other cybersecurity companies, here is what you will find. CrowdStrike, Palo Alto Networks, Zscaler, Palo Alto, okay, and I want to find the compensation. Compensation as a percentage of revenue, maybe. What can I find? Do you have a ratio for this? No. Capital efficiency, no. Capex, no. Oh, I can show you something else. I can show you the capex compared to the revenue for all these businesses in the cybersecurity industry. What you can see is that for the past 10 years, the whole sector didn't need a lot of capex. You can look at all these companies. They don't need a lot of capex. In blue, you have Fortinet, by the way. They pack middle of the pack, right? So now they need 0.06%. Like 6% of the revenue is being used to fund the capex. Very small, and I don't see this changing over the past 10 years. This means the business will not have to burn cash like you have for big tech companies like Google, Amazon, Meta platforms very well. I would like to see the compensation, but I don't know if I can see the ratio here. No. So what I can do, this is the joy of knowing multiple websites at the same time. I can check this metric on Stock Unlock. By the way, guys, you see me navigate between Stock Unlock, Google Focus, FinChat. You have discount codes in my description. So if you want to try them out, create a website for FinChat and Stock Unlock, I have an affiliate link. It's minus 15%. So it's literally cheaper if you use my link. So please use my link. You will like it. You will like it. Literally, it's a discount code. SBC as a percentage of revenue. Here we go. We don't have this metric on FinChat, but we have it on Stock Unlock. So I said I wanted to compare the SBC to the other companies, and you will understand what it means. Basically, like all tech companies, SBC is high for this industry. That means every year, regardless if you make a good job or not, regardless if profitability improves or not, the employees are being rewarded for doing a good job, and they have stock options, free stock, literally free stocks that is being given to management teams. Am I forgetting something else? Let's scalar. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Could be it. You have what? Sentinel-1 also? Yeah. I mean, Sentinel-1, that's not exactly the same kind of business. Am I forgetting something else? Anyway, you will get my point. Okay. Very well. Okay. What you can see from this chart is the SBC as a percentage of revenue. As I told you, this industry, like the tech industry, is rewarding the management teams by a lot. And you see that for the peak one, Sentinel-1, that's 32%. The SBC is 32% of the revenue. Like, it's as if you generate $100 of revenue, 32% is used to do SBC. It is not exactly how it is done, but the lower the better. Sentinel-1 is the highest out of all, so we can remove Sentinel-1 from our list. What is the most expensive one? Who is winning here, the shareholders or the management teams? In brown, you have Zscaler. 25% of the revenue is SBC. That's a lot. And it has been growing massively during COVID. At some point, it was like 40% of the revenue as SBC. It's very, very, very high. What do you have in blue here? CrowdStrike, that has increased its SBC as a share of revenue massively since 2020 and now 2025, and we are at 22% for CrowdStrike. 22% of the revenue as SBC, okay? What do we have in green? In green, that's Palo Alto Networks. This line, SBC as a percentage of revenue, has peaked at 30% in 2016. And since 2016, so for the past 9 years, this has shrinked. It's very good to see this actually. That means the management is getting less compensated as a percentage of the revenue growth, right? So it is shrinking to 13%. And now we are getting very low. Now I can show you the purple line, which is Checkpoint. Checkpoint, that's not a growth company at all. It's a cybersecurity company, but there you can check for yourself. The revenue is not growing, the free cash flow is not growing. That's a buyback machine, but I'm not comfortable with the price right now, with the valuation. You are at 5%. And who is the lowest of the bunch? Which company is not rewarding the management teams? Which company is thinking in terms of the shareholders' perspective? This is Fortinet. Fortinet here in purple, never mind, in turquoise, in blue, that's 4% of the revenue as SBC. It wasn't always the case. In 2015, like 10 years ago, It was like 9%, but it has been shrinking over time. Let me show you this. Okay, this is Fortinet. This is the SBC as a percentage of revenue. In the past, it was 10%. As I told you, the lower, the better. And for the past 10 years, it has gone down. Now, it's the lowest remuneration, lowest compensation compared to the competitors because of this high insider ownership. I showed you in the past the insider ownership. The management team doesn't need free shares. They already have 15% of the shares. So literally, they don't want to dilute everybody else. They want to do buybacks to increase their ownership in the business. Okay, so I told you that we had some efficiency gains, compensation structure that favored the shareholders. What about the costs compared to competitors? If I check the R&D, I want to show ratios, capital efficiency. No, I think that's common size. Oh, I had this metric. Too bad. I spoke too fast. I have the SBC comp to revenue on Fiscal AI. I just didn't know it was there or forgot. Okay, here we go. You have the same line. Okay, sorry for the waste of time. I already had this metric here. What you can see is Fortinet is now the company that pays the least the management team. Okay? And all the rest are up. I mean, you go from 4% to 24%. That's a lot. I mean, in terms of mindset, incentives, that's a lot. I mean, regardless if the business does a good job or not, management will get a compensation. That's quite terrifying from a shareholder's perspective. I would prefer to invest in a company that doesn't pay the shareholder, that doesn't pay the management teams by a lot, that doesn't reward complacency. They just focus on the shareholders. The other thing that differentiates Fortinet from the rest of the pack are the expenses. If you look at the SG&A to revenue, SG&A, the salaries, the administrative costs, etc., you will see plenty of differences for the other cybersecurity companies and Fortinet. So Zscaler is having 50% SG&A cost as a percentage of revenue. You have incentives, they reward employees, salesmen, etc., sales team. You have CrowdStrike. This is trending down, but still 50% of the revenue. At the same time, you have Palo Alto Networks that is here down. Fortinet is here. That may be one of the lowest. And you have Checkpoint here. If I show you the latest data, who is at the bottom of the chart? Who has the minimum cost? Again, you find Fortinet. Equally as low as for Checkpoint Holdings. So first difference between competition and Fortinet, less compensation. Second difference, less SG&A cost. Minimum SG&A cost out of the bunch of the cybersecurity companies. Third difference, and after this I will move on, that's the R&D to revenue. How much do you invest to have new products, etc.? Well, you have similarly CrowdStrike that is at the top, and then Zscaler, Palo Alto Networks at 20%, 20%, 20%, and then you have Checkpoints that is 15%, and again, bottom of the pack, you have Fortinet. R&D to revenue is 12%. So they don't need a lot of capital to grow 20% per year. So now you may think, yes, Fortinet doesn't have any costs, but maybe they don't innovate as much as the rest. You may be right, but that doesn't stop the company from growing 20% per year. Maybe that's a sign of a moat to have minimal investments, minimal capex, but still revenue is growing 20% per year. Maybe that's a sign of a moat, and I will let you do the research to check this, because I don't want to to tell you everything on one video. You still have to do the work. So less cost, more efficiency, and less compensation. That gets you to margins that are rather high compared to competitors. If I look at the margins for, what can I check? This one, I can check this on Stock Unlock anyway. Oh, that will work. If I check the margins for, you know what, let me, because of the accounting change, the gross margins of this business, we are still a business that is growing their margins. They don't have R&D costs, they don't need capex, but the gross margins went up from 70% to 80% right now, roughly 80%. So improving margins. What do you get? Net profit margins at 30% right now. The big spike you see here is because of the accounting change. So before it was at 15, 20%, now it's at 13%. So the minimal investments don't stop the company from improving the margins and continuing to grow revenue. Now you will understand why the stock has dropped significantly since they reported earnings. Okay. First, let's start with the revenue growth rate. For this company, that's on an annual basis. As you can see, it can fluctuate widely between 15% to 30%, 15%, 30%. And now we are at roughly 15%, okay? I can show you more granularity, more details, and here is the smooth lines about the last 12 months. Revenue growth rate, roughly 20%, 15%, 20%, 30%. During COVID, it was a big boom because of the product cycle. A lot of the hardware equipment had to be refurbished. You had to renew your equipment, cybersecurity equipment, and you had a lot of demand in 2020, 2021, 2022. So now that the product cycle is over, you will start a new one. So revenue slowed down a little bit. Revenue didn't decrease, by the way. It's just that the revenue growth rate is decelerating back to 10% per year. And now we are back to 15% per year. Guess where it will go in the future. I will not tell you where it will go. Nobody knows, but my guess is it will not go down significantly. You have a new product cycle. And the stock dropped because during the earnings call, the management said that they already started the product cycle, the new product cycle. We are halfway through 40 to 50% in this cycle. So Wall Street analysts expected this new cycle to boost growth in revenue. And apparently we already started the cycle and we didn't have this big uptick, this big spike of revenue growth. That's it. That's I would say one of the main reasons why the stock dropped 20%. People expected a new cycle, but when the cycle kicks in, boom, you expected a lot of growth in revenue, which is not the case. So maybe they are late, maybe they don't have much pricing power. I've already seen these exact arguments being made in years in the past, so I'm not so worried about this one. I want to show you the billings of this business, KPI as a segment. This is a revenue growth rate. Oh, I have to check this on a quarterly basis. Fortinet is a company that sells products, but also services. And over the past few years, this is the reason why margins went up. They have shifted from more revenue in terms of products, and they have shifted from products to services with the better margins. So over time, this is a percentage of the revenue, right? In red, this is the product share as of revenue. It means that during COVID in 2020, 40% of the revenue was product, hardware, and 60% of the revenue in blue was software. Guess what? Since 2023, in terms of share of the revenue, the product revenue common size went from 42% to 31%. So as a percentage of the revenue, they sell fewer hardware. This is still growing, but services are growing by more than this. It went from 60% to 70%. I think this trend will continue, if not accelerate, in the future. They will sell as a revenue more services than products. So margins can continue to go up. The world is getting more digital. They sell more and more cloud equipment. The SASE service they are selling is growing 30% per year. So for the moment, everything is going in the right direction. I even created custom metrics for this business with the product gross margins and the service gross margins. Look at this. In blue, that's the software margins, 80%, 86%. And in red, that's the margins for the products. Still high, but services is higher. Services is more profitable. And as the company is shifting for more services and more services in the future, margins will continue to grow. And they will go back to 80, 85% per year. I mean, go in this direction. I'm not telling everything will go up massively to 80%. I'm just telling you margins in overall will continue to increase. So we've seen the growth rate. We've seen that the management is very rewarding for shareholders. We've seen the buyback program. We've seen they don't like to dilute shareholders. We've seen the SBC and the cost as a percentage of revenue. So Fortinet is being more efficient than the rest of the other cybersecurity companies. And we've seen the reason of the drop. You have total revenue. Yeah, this is it. I mean, revenue was down and up to 15%. Wall Street has expected better. Same thing for the billings, right? Billings went up by 15%. Let me show you this. Billings went up by 15% percentage change. Total billings. Okay. In red, you have the percentage growth rate of revenue. And in blue, that's the billings growth rate as a percentage. And on a quarterly basis, here is what we find. A strong correlation, obviously. Billings follow the hardware part. If you want to continue the research, you will find this correlation. What you find is the company is rebounding from 2024. Revenue is rebounding from 2024, stabilizing around 15% per year. And the billings are continuing to go up again, to rebound strongly. If we look at the billings growth rate, we are at 15%. This is no panic at all. 15% growth rate in billings, 15% growth rate in revenue. I mean, I don't see the panic attack people had during the call. I suspect the reason why the stock dropped, I mean, you can have two reasons. The first one is they expected better because we are almost halfway through the upgrade cycle when it comes to products. So they expected the revenue to go up by more than this. And secondly, I want to mention valuation. I want to mention valuation because this is quite important. As I told you at the beginning of the video, I bought Fortinet in 2020. It was at the end of 2020. So it should be here in November or anyway. Let's say I bought Fortinet in October 2020 and sold at the beginning of 2022 or at the end of 2021, I think. I think it was here, just when it started to oscillate widely like this. So I bought Fortinet with a forward EV to free cash flow of 20, and I sold at a forward to free cash flow at 45. And since then, the stock has been trending quite expensively, I would say. If you want to know why I use the forward EV to free cash flow, maybe I can make a dedicated video on why this is a good indicator of value. I'm discussing this with my students inside the coaching program. We are using EV because the company is net cash. So the company has more cash than debt. You have to account for the quality of the balance sheet in the valuation. So if you compare the enterprise value and the market cap, I would say EV is a better indicator of valuation for this kind of business that is sitting on a lot of cash. let's say they have $5 billion of cash and the market cap is almost $50 billion. That's almost 10% of the company being sit as cash. So I would say now that's what, if you adjust that 7 or 8% of the company as cash, you have to account this in the valuation. Same thing if the company had a lot of debt, you have to account for this, okay? And we are using the free cash flow because it accounts for the way it's the way the accounting works for cybersecurity companies. People pay in advance for subscription. And as I told you, the earnings of the business, the net income of the business changed in 2018. The formula for having the net income. So net income is not a reliable source of profitability if you want to see the profitability of this business. Cash flows, operating cash flows, free cash flows are better tools.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
So the stock was trading expensively in 2021 at 40, and then it oscillated widely from 20 to 35 again, to 20 to 35, 40 again, and Fortinet went to the earnings call couple of days ago with the EV to free cash flow forward of 30-35. With this kind of valuation, you don't have to disappoint. You need stellar earnings to justify the high valuation. And management disappointed a little bit with slower growth than anticipated. So one, you expected better growth, so you are disappointed first. And two, you have this kind of disappointment because you expected better with a high valuation. That's a very difficult position to be in. So the stock dropped 23% in one day because of this. The market multiples were just too high to justify a slowdown or this kind of revenue growth. And now we are talking about, I bought here at 23 again. I opened the position for Fortinet, 4% of my portfolio. It's a starting position, and if the stock drops, I would be very happy to buy more. So the stock is not excessively cheap right now, but I would say it's fairly valued. A little bit cheap to fairly valued. I'm starting a position with some good confidence, I would say. I've been following the company for a while, so I know there are some skeptics, and there have always been a lot of skeptics about the lack of innovation, about the moat, about the pricing power. It will always be the case, but I'm not worried. I'm not worried at all. The company is still in a good shape. The company is still a net cash. And now we are reaching a decent valuation, I would say. If you want to see this and compare this with the price to free cash flow, if you want to not take into account the cash, we are at 24. So that's for the trailing, and let me show you the normal price to free cash flow. Normal price to free cash flow for 2025 is 29. And if you go to the forward, you are at 24 or 25. Anything can work actually. Price to free cash flow, EV to free cash flow. You get my point. Valuation drops significantly. So, what is priced in for the stock right now? What is Wall Street expecting? Wall Street thinks that the revenue will grow at 12% per year, 11% per year. They think earnings per share for this company will grow at 10% per year, 13% per year. Wall Street thinks the free cash flow will grow at 14% per year, 14% per year. What have we seen before? We've seen a company that can grow sustainably at, they have done it for 20 years, right? 20% per year. What are the reasons why they couldn't do 20% per year? You have a big tailwind in cybersecurity. Now you have an additional tailwind with the AI. You will have a lot of AI threats, AI attacks, cyber attacks. You will need a lot of AI defense. Fortinet has a lot of patents to innovate in this industry and have already started to implement their AI cyber defense services. There will be high margins, very incremental. They've been preparing it for 10 years. The leaders the founders are still here. They have this vision of seeing the future in this industry, and I see it very likely that the company will grow by more than this, more than 12 or 13% per year. I would say this company has a good chance of growing between 15% and 20% per year. If these are all your assumptions, how do you calculate a DCF? You can either use free cash flow or operating cash flow. For the sake of the exercise, let me do things very simply. I'm on Stock Unlock right now. This is the best DCF tool I've been using. And let's calculate our fair value for this business. So we are on the DCF calculator. You have the free cash flow here. What will be the free cash flow growth for the next 5 years? Let me remind you that for many years, the free cash flow has been growing at 25% per year. If you want to be bearish and you want the slowest growth in free cash flow, you can say 16% per year. Since 2023, I mean, that's if you want to take literally the peak, you have flat growth for 2 years. Yeah, I would say this is very unlikely. I mean, this is peak product cycle and you had working capital changes here. If you want to be conservative for the free cash flow growth, I would say you can put 15%. If you want to be conservative, let's say they will not do buybacks. At the same time, if you go to Fortinet, you go to investor relations, and you go to any of their press releases, any of their speeches, the management team is very clear. Analysts today, they love buybacks, and they will continue to do buybacks in the future. Overall, they have spent a couple of billions of dollars in buybacks, which has increased the earnings per share by 35%. Okay, what is the CEO telling us during the analyst day? Buyback. I mean, if you look at the slides. Okay, let me first show you the paragraph and then I will show you the slides, because these are the things you can't have in a spreadsheet. This is also what I want to show you. In the analysis of a company, the quantitative analysis is important, but also the qualitative aspect of the analysis is important. So we've talked a lot about quantitative metrics, numbers, etc. What about qualitative metrics? What about the tone of management, the priorities of the management? Okay, so the CEO a couple of months ago said, buyback return to investor. I don't see any other cybersecurity company do this kind of buyback. So you can see we actually reduced the share count by 35%. It is not true. It's they increased the earnings per share on a per share metric by 35%. 35% more. So we spent $6 billion in buyback since the IPO, and we also try to make sure we have a buyback program continue going forward. So that was for the paragraph. And then I just figured out I had the investor presentation for May 2025, but my point is still valid regardless of the year. So for May 2025, we have 28 slides. Don't worry, I will not show you the 28 slides. I will show you the first ones. Let me show you the first slide. This is the title. Slide 2, these are the disclosures. Slide 3, the overview, the growth rate, the margins. So this is counting as the first slide with value. And what is the second slide here? They talk about the buyback program. For other companies in the cybersecurity industry, you don't have this emphasis on buybacks. For Fortinet, literally that's their second slide for the investor presentation of May 2025. Second slide, that's another qualitative metric to monitor. What are the priorities of management? What if the buyback program was not a priority for the management team? They would have put this slide at the end of the slides. But this is their second slide. First, financials. Secondly, buyback program. So they had $7 billion of cash rewarded to shareholders. This is an increase of 35% on a per share basis, and you have $2 billion remaining, and this is their buyback program. As I told you, now they bought back $400 million of shares. that were during the April correction. I think I'm almost sure. I mean, it would be a mistake not to do buybacks at current prices. Okay, so let's say we are being conservative and they don't plan to do any buybacks in the future. I told you we are being conservative. So 0 buyback, 15% growth in free cash flow. And what is the price to free cash flow for this business? I mean, let me check. What has been the price to free cash flow for this stock for the past decade? Let me put the average. Let me put the median here. Let's say the average is 28, 29. And the median is 26. Fair enough. You know what? Let me put 26. I can put 25 if you want. Let me put 25. If you think they deserve a price to free cash flow of 25, you think it can continue to grow 15% per year, conservative, 0 buybacks, at a lower multiple than the median for the past 10 years. So we are talking about a bear case scenario. The bear case scenario is a CAGR of 11%. 11% could be a bull case scenario for some businesses. What I try to say is, even if you have low forecast, low assumptions, conservative assumptions, you can still deliver 10% per year, 11% per year, because the business will keep grinding. Now let's talk about the real ones. What do I think the company will do in the future? Maybe this is the reason why you clicked on this video. By the way, don't forget to leave a like, subscribe. I take advantage of this long video to tell you to join the community, join the party. If I think they do a 1% buyback program, and if they continue to grow, maybe I don't want to put 20%, it would be too bullish. Let's say 18% per year. As a reminder, they did 25% per year. And if we don't touch the multiple of 25, it's a CAGR of 15%. Now, if you look at the valuation metrics, it wouldn't be too crazy to think that this is a quality business that can trade at a little premium to the market. It was the case even before COVID. Even before COVID, just at June 2020, just after COVID, price to free cash flow of 28. February 2020, price to free cash flow of 28, 26. 26. I mean, it can grow even though it's they have some hardware parts, they are shifting from hardware to software. And we know that software companies trade at a premium compared to hard assets companies. So instead of 25, if we put 30, that changes everything. And now we tackle the 20% per year. And I say this being conservative in the growth rate. If you put 20% growth rate in free cash flow, this is just heaven, but I will not bet on this one. This is a little bit too bullish. I'm not crazy to put this in my for my estimates, but this can happen. I don't know if this will happen, but this can happen. They do a buyback program of 1% every year. Growth is coming back again. Efficiency is coming back again. You grow free cash flow by 20% per year, and you deserve a price of free cash flow of 30. You have a CAGR of 22% per year. But let's not say this is our bear case, right? Let's say this could be our bear case, our base case. That could be a good base case, actually. You grow 15% per year. You deserve a price to free cash flow of 27. You do a buyback of 1% per year. If these are your assumptions, then the stock is 20% undervalued. And if you buy now, you can expect a 14% CAGR. Now we've talked about the bear case, we've talked about the base case. What if Fortinet and all the cybersecurity companies benefit from AI? What if the same way they benefited from COVID and the digital world, they benefit from AI and the digital world? Again, we've seen this scenario happen again. We've seen this scenario of a slowdown, worries, and then what if AI cybersecurity grows massively in the future? What if all the budgets for companies, the cyber budget for big tech companies, what if it improves a lot? And instead of growing 15% per year, everybody's growing 25% per year. Nobody knows if this will happen today, but I'm thinking for the long term, right? On this channel, we don't trade stocks. We invest for the next few years. So if I want to hold my Fortinet stock for the next 5 years, maybe the cybersecurity industry will grow much more than we think. It's too early to tell, but let me show you the bull case. If you have an investment that can grow your free cash flow at 25% per year, like they did in the past, but you have an acceleration of the free cash flow, 25% per year. And if you think because of the high growth, it's a high quality stock, and you have a price of free cash flow of 30% per year, now we are salivating. And if you buy now with this kind of assumptions, you can expect a CAGR, compound annual growth rate, of 26%. This is the kind of results everybody wishes for. This is the kind of results that you have in the exercise, as I am doing right now, but it's not your base case, right? It's in case the cybersecurity industry is thriving because of big AI investments, efficiency gains, big budgets, etc. Geopolitical conflicts will help, obviously, in this kind of industry. I would not say it's impossible they do this. I would say you have I would not say a probability publicly, but you have a decent size of a percentage that this scenario happens. So this is the bull case, 26% per year. The base case could be 18% per year. The price of free cash flow, you do whatever you want. But that can generate roughly 15% per year. And your base case is a growth rate of 20 if you want to be pessimistic maybe. Your bear case is 7% per year. Very unlikely it happens, in my opinion. So that's it. You now understand why I started a position for Fortinet. And it's not a full position, it's 4% position, because I plan to buy more as it drops. And I hope it drops. But just in case, and I want to feel bad about not buying the stock, just in case, I bought and I opened the position. But now it's not excessively cheap, as you saw. So it can go down more than this. I don't like the price of free cash flow because the company has accumulated so much cash right now. You have a EV to free cash flow. I can even have forward because, anyway, it can go down from 27 to 17. It was a little bit extreme, but let's say 20. From 27 to 20, it can happen. And if it drops more, I think I will double the position from 4% to 8%. And if it continues to drop more, I can triple the position from 4 to 8 to 12 the position, 12% of the portfolio. Because I'm quite confident in Fortinet. I hope this video will age well. We'll see in the next 5 years. But I've been monitoring the company for a while. And these are all the reasons I'm buying. Management knows what they're doing. It's one of the lucky few companies in this cybersecurity industry that are focused on buybacks. We have a growing industry with a good tailwind in the future. And if you look at the history, the track record, this is a company that has grown all the fundamentals, operating cash flow, free cash flow, revenue, by 15% per year, 20% per year, 25% per year. You have better margins. The company is shifting from hardware to software. They have minimal capex, and they plan to reward the shareholders very well. So these are all the reasons I'm buying Fortinet. Now you have a lot of panic because of deceleration of the billings, revenue, and I think it's fairly priced. So we'll see how it goes, but it was all the reasons why I just bought Fortinet.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. click the first link in the description below to get more information. You will get a video, a short video that explains how everything works completely for free. No need for your mail address, just click the first link in the description and I'll see you on the other side.